that you check second-order conditions. So in an individual optimization problem, you had to check that the marginal cost curve was cutting down below the supply, above the price, right? And similarly here, anytime you have a market equilibrium, you have to make sure that the demand curve is cutting down across the supply curve and not in the opposite direction. So just to show you a picture of that, let me just switch the axes versus what we usually do. So I'm going to put price on the horizontal axis, and I'm going to put quantity on the vertical axis. And let's put supply in red, demand in red, and supply in blue. So if demand slopes downward and supply slopes upward, then if we increase supply, that is, we increase the quantity at any given price, then as we see, the price falls, right? The price goes down. On the other hand, imagine that we had things going in the opposite direction. So imagine that demand went upward and supply went downward. Then if we raise supply, the price actually rises. So that's the opposite of what we think, because things cut each other in the wrong direction. Now to see that it's not about things all going in the right way, but about cutting each other correctly, let's imagine that both demand and supply slope down. But the demand slopes down more quickly than supply does. Then if we increase supply, we again get things going in the right direction. The price goes down when supply increases, as long as the demand curve cuts from above to below the demand curve. On the other hand, if we change this so that the supply curve was sloping down more steeply than the demand curve was, then if we increase supply, we get a higher price. So in general, no matter which way things are going, the key thing to check is that the demand curve is cutting from above the supply curve to below it. Okay. So, just as with trade, as with pure exchange, with production, all equilibria of the economy are efficient. And the only thing that's been added is that in addition to everybody's indifference curves being tangent to one another at those prices, like you get in the Edgeworth box, also all of the marginal rates of transformation, all the production possibilities frontiers are tangent to one another. So if you take any two companies, they're all going to set their production possibilities frontier tangent to the market price. So any two companies' production possibilities frontier will be tangent to one another. And any company's production possibilities frontier will be tangent to any consumer's marginal indifference curve. And any two consumers' indifference curves will be tangent to one another. So all the marginal rates of transformation will be set equal to all the marginal rates of substitution for everyone in the economy. Because every person is going to set the ratio of prices equal to their marginal rate of transformation or marginal rate of substitution. Production here is really no different than consumption. Just as some people enjoy having certain foods more than other foods, some people are better at producing certain things than at producing other things. And what this means is that just as with pure exchange, all market allocations are Pareto efficient. This is just the invisible hand again, but what it means is not just that markets are efficient, but that using the idea of a market can help you to figure out an efficient allocation even in cases that don't necessarily sound like market type situations. So, Eric, can you think of some examples of cases where you could use a market to figure out what's efficient, even when it's not naturally a market type of a situation?
You mean like When you say not naturally market, you mean not like normally buying and selling goods?
Yeah.
I mean, all we do in econ is abstract things to being goods
Yeah.
traded. So, all the examples I can think of involve like stuff that is conventionally abstracted into a good.
Yeah, so in the reading we went there was a couple of examples given. One was the marriage market, right? So Gary Becker made this, and Gail and Shapley made this argument that marriage is just like a market, right? People are competing for the best person they can get, and the more attractive you are to other people, the higher price you effectively have, and you can use that to get someone who's attractive to people on your side and so forth, right? Now that sounds like a sort of silly, but in fact, on the basis of that idea, Gale and Shapley proposed a centralized way to do marriage. That everyone would submit a list of everyone that they prefer, and they would just be matched by the system to someone else. Now that sounds totally crazy, but in fact that's exactly on the basis of that model how the kidneys are allocated in the United States now. So what happens is people submit lists of which kidney is the best match for the one that they're donating, because they want to get a kidney, say, for their sister who's dying, so they donate their kidney, and then they're matched with somebody else who you value the most and who values you, and so there's basically a market for kidneys. But because people are afraid of using money, the market has no money, it just has this artificial market mechanism. And that's how the medical match works as well. If you become a doctor and you want to figure out where to go do your residency, you'll rank all the places you could do your residency, they'll rank all the doctors, and then there's an artificial market which determines who gets allocated there. Another example of this is course allocation. So we don't do this in the arts and sciences faculty here, but over in the business school, the way that you figure out what courses you get into is not just like the sort of lottery bait sort of system that you guys have. Instead, people are given money. They're basically given like little monopoly money, and they can go and bid in auctions to get into courses with their monopoly money, right? And you keep your money, because if there's not so much, if there's not a lot of space in the course, then the price is going to be really high, and so that allocates people efficiently across things. So even if it's not naturally something that a market would allocate, you might want to use a market to allocate it. And an idea that I've had that people haven't really written about, but is that a lot of people aren't actually very good at making financial decisions for themselves about their retirement. One thing you could do is you could have a computer system that like interviews people, figures out what would be the best allocation from them, and then you could have a little financial market inside of a computer where everybody trades with everybody else, but it's all just like the computer optimizing the allocation among everyone, right? Rather than having people actually like making decisions and making trades, which we know is really inefficient and spends a lot of money. People don't know what they're doing. It leads to panics and crashes and stuff like this. If you just had it all inside of a computer, the computer could sort of optimally allocate what everybody has in real time. And then when I buy something from you, rather than me using my credit card, I could just say, transfer a certain amount of money from my account to your account on the computer. Everything could go on inside of there, and you would sort of like never even know about it, right? So anyway, there's lots of ways you can use markets in settings that maybe don't seem natural as ways to use markets. Okay, so the second welfare theorem also holds with production. You just have to redistribute the right amount of money, and then any efficient allocation can be achieved by the market. And this leads economists to generally argue that redistribution of wealth should happen not by like changing prices, but by directly redistributing money as much as possible. And then markets should be allowed to operate. So, Connie, why in practice is it difficult for the government, rather than redistributing based on the income that people are currently earning, just to like directly say, look, you need to give me this much money, this other person needs to give me this much money, and so forth?
I think the reading had an example saying if they taxed labor, it would that would affect how much people want to work.
That's right.
So
But
that's why-
but the proposal that they were saying, the reason why we do tax labor is for another reason. I mean, that's obviously bad to tax labor. It would be better if we could just tell each person how much tax they owe without looking at their labor at all. But why is that hard?
Well, because then if you don't have any income, how would you get?
Exactly. That's exactly right. So the problem is that, you know, you have to be able to redistribute in a way that's independent of what people are doing, the actions that people are taking. But most people have most of their wealth in the form of their human capital, in you know, their personal abilities, and it's really hard to figure out how much that's worth, right? The wage that they're currently earning doesn't really tell you, because most of it is in the future, you know, and who knows what they're gonna end up doing in the future. And if you tax them doing something really ambitious, then they're probably not going to do that very much, right? And you know, the other problem is exactly what Connie said, which is, you know, what do you do if you say, look, you owe the government $100,000. You could just not be able to make or not choose to make $100,000. Then what's the government going to do? Throw you in jail, or you know, torture you, or throw you out of the country or something? Probably not, right? I mean, for example, imagine someone's really talented and they could make a lot of money. So you want to make them pay a lot. But then what if they want to go and like be an artist or travel around the world or be a bum for a year, right? What are you going to do? Throw them in jail because they didn't make the money that the government, you know, required them to pay? Or you know, even less extreme than that, what if they just wanted to do public service, which they're not going to make very much money at, right? So that could be a really bad system. Now, there is an exception to this, which is that Henry George proposed taxing land. Not property, not how much the land is worth with the houses that are currently on it, but how much the land itself, if you knocked everything off of the property, would be worth. Because that you can't change, right? The land is just there. No one's, I mean, unless you're going to go around like blowing up plots of land, like basically it's just there. And unfortunately, this never became very popular. You're on? You're on? You're Elaine, of course. Elaine. Elaine, why do you think the land tax never became very popular?
I don't know, is it because people own like houses rather than apartments, they would have to pay a lot more for the land for the house?
Yeah, I mean, that's a little bit part of it. So it can be very unfair if there's some super rich person who owns a beautiful apartment on a tiny plot of land, and another person who is really poor but has like a farm on land that's worth a lot. They might be forced to sell, you know, their family farm just because, you know, this land tax comes in order to pay the tax, right? And so a lot of people thought that that was very unfair and therefore have opposed this. But it is something that's more efficient than other ways of redistributing wealth. Okay, so in the real world, the interpretation of the second welfare theorem is not that we should only redistribute in these super efficient ways like a land tax, but rather that redistribution should be as direct as possible. So, you know, if we can't literally observe how much people have, we should try to tax the thing that's the best possible proxy for what they have, rather than sort of things that are a bit random. So taxes should fall on something like income or total consumption, some other overall measure of how well you're doing, rather than on very specifically how you do it. So many economists even oppose taxes on capital gains, taxes on savings, because they think that this leads people to save too little. And that it would be better just to tax something more like the overall amount that they purchase, their consumption, rather than their savings. Second, economists pretty strongly think that redistribution should usually not affect the prices of different goods. So in many countries, especially poor countries, a typical way that they try